Benefits and hindrances of C partnerships. Entrepreneurs often overlook the C partnership as a viable option. Choosing to work as a C partnership offers primary benefits that other business types, such as an LLC, cannot. An examination of a few of the advantages and potential drawbacks of C partnerships is presented in this article. How does a C organization work? The C corporation, also called a c-corp, is a legal element that protects the owner's own resources from creditors. It can have an unlimited number of proprietors and different classes of stock. As a result of these qualities and benefits, it makes an excellent vehicle for attracting funding and generating value support. It pays charges at the corporate level, not at the level of S partnership or LLC. In other words, it is dependent on the hindrance of twofold tax collection. C corporations must also follow a lot more government and state regulations than LLCs. The following benefits are associated with C enterprises. Persons with separate legal identities. Owners are at a reduced risk. Presence that never ends. Divide between proprietorships and executives. There are no restrictions on who can own shares. Offers that can be adapted quickly. Points of reference that are deeply rooted and legitimate. Abounding recognition from financial speculators and lenders. Investment capacity. The charge of arranging valuable openings. Is your business likely to benefit from these C organization benefits? Enterprises are independent of their owners. A company has an unmistakable overflow of energy, with its own privileges, capacities, and obligations. As a result, a corporation can sue, or be sued, on its own behalf. Among its abilities are the ability to purchase, own, and utilize its own genuine or individual property, make its own agreements and assurances, lend cash, and contribute reserves. There is limited risk security offered by an enterprise to its owners. Since an organization is a separate substance, it has its own obligations, commitments, and liabilities. Partnership employees should focus on fulfilling commitments owed to them, not on investors, when working with a partnership. Investing in a company limits investors' exposure to misfortune. There is no end to the presence of an enterprise. Since a company exists independently of its investors, it has a ceaseless presence. For instance, if a sole proprietor passes away, the business ceases to exist. When a partnership is framed, it keeps on existing until it is broken up, damaged up, and sold, unless its articles of joining give in any case. Furthermore, the exchange of stock portions does not affect the partnership's existence. Offers are free to be adapted. Financial freedom and board freedom are both granted by corporate stock. An investor can unrestrictedly sell those offers, and the purchaser will be the investor with those privileges. LLC members can sell their financial freedoms, but not their administration rights. To have the purchaser become a part of the LLC must get consent from other individuals, unless the working agreement stipulates otherwise. Financial backers are more likely to invest in C enterprises. A C corporation has the advantage of attracting financial backers more easily, including through value funding, than an S corporation or LLC. Owning shares is generally viewed as more desirable than owning LLC enrollment interests. Additionally, financial speculators invest in C enterprises. In addition, because of limitations in their own administrative archives and assessment regulations, many financial speculators are not able to fund S companies or LLCs. Furthermore, organizations planning an IPO generally favor corporations to LLCs and cannot choose S company status due to the 100 investor limit. Bank support may also be easier to obtain for an organization. Capital-serious organizations can particularly benefit from this element. Investors are not restricted. It is not restricted who can own stock in a C corporation except if the partnership's overseeing reports indicate otherwise. In addition, charge regulations limit who can claim stock in an S corporation. S companies cannot be owned by non-US residents or non-resident outsiders. All things considered, organizations and LLCs can't invest in S partnerships. S partnerships are also limited to 100 investors. Organizations don't directly deal with investors. There is a top management staff that selects the officials responsible for running the day-to-day operations of an organization. Each state's partnership regulation accommodates this. As a result of the number and type of offers held, an investor is eligible for financial benefits, but he does not have the right to manage the business's day-to-day affairs. Administration privileges are limited for investors to choosing chiefs, removing chiefs under specific conditions, deciding on specific significant construction changes, like consolidations or dissolutions, and investigating specific books and records. There is a deep-rooted tradition of corporate regulation. Being the most experienced type of legal element is beneficial since there aren't many surprises left in corporate law. While states fight over what corporate practices apply to LLCs, many of the basics that apply to partnerships are firmly rooted. Boards can therefore more likely anticipate the legal outcomes of their choices, and financial backers can draft arrangements to safeguard themselves as a result of knowing the effect of changes in corporate design. There are many responsibilities and opportunities that come with partnerships. Organizing your business might entail more complexity, but it also provides a wide range of opportunities for duty arranging. A trustworthy charge advisor should examine the expense implications of being a C partnership versus an S firm or LLC. How does a C enterprise disservice its customers? In addition to the benefits acquired from C enterprise status, there are a few disadvantages as well. There are two significant inconveniences. Intricacy. The process of running a company is more complex than that of running an LLC. There are more conventions in how a partnership is formed under the enterprise regulations. It is necessary to hold investor and chief gatherings, for example. Minutes should be kept, and appropriate notification should be given. In contrast, LLCs can be overseen all the more casually. It is also common for enterprise regulations to stipulate stricter record-keeping requirements. Tax collection on two fronts. Except if it makes a political race to become an S company, an enterprise is not a duty-paying substance. Accordingly, a C organization pays corporate personal expenses on its pay after balancing pay with misfortunes, derivations, and credits. As a result of its after-charge pay, an enterprise delivers profits to its investors. Profits are then charged to investors annually. The twofold tax collection is often referred to. There are, however, ways to lessen or eliminate twofold tax collection that an expense guide can suggest. Compare the benefits and burdens of a C organization with your business requirements. Working as a C organization has its benefits and burdens. You can assess whether this is suitable for your business and your growth plans with the assistance of your bookkeeper and lawyer.